Hi Gary, how are you?
Good, thanks, Leo. How are you?
Yes, I'm well, thanks Gary. I've been digging into your latest article. Um, Last week you said that you'd be looking at the relationship this week or the lack thereof between GDP growth and asset returns. What did you find?
Well, there is no relationship between GDP growth and asset returns in the same year. And the reason I looked at that was because it's very easy for investors to get panicky when they see dreary forecasts like the OBR's minus 35% quarter on quarter drop in GDP for Q2 in the UK. And the point I wanted to make is don't get fixated on what's happening to GDP now, because equity prices tend to discount what's going to happen in the future. And that was the gist of the point I was trying to get across in my article.
Okay, Gary, so chart A, we've got two numbers here. We've got the 2020 number of 20 minus 23.17, while the government forecasts minus 35. I thought you could tell us what the correlation, if any, between those two numbers are, and also what's this big 1974-75 story?
So the fall of just over 24% for the period this year is up to the 24th of April. I just put it in because I thought the series needed to show what's happened in Q1 this year. But remember, that's the market moving ahead of what it expects the economy to do in the next quarter, which is to have a pretty bad effect. So don't get carried away with that. It doesn't mean the OBR is saying that equity values are going to fall by 35% this year. What they were saying was in Q2, the second quarter of 2020, UK GDP is going to drop dramatically because we're all on lockdown. That doesn't necessarily move into equity markets, although it has spooked equity markets early doors. Now, when you look at chart A, and you see the very, very bad falls of 1974. That was in the 3-day week when we were on a lot of lockdown. I remember that was during my first year of work, and we were literally sitting around in the cold for 2 days with paraffin heaters and candles to try and do some work. And it was a pretty dire period, and markets were doing bad. And it was also an inflationary period, and stock markets got very, very spooked. The economic position back then was a lot worse than it is today.
And then this spike in 75 into the positive 141%.
Well, that shows you, doesn't it, that sometimes after a very dire period, when people get emotionally upset and start selling assets because they panic, it settles down, and all of a sudden people want to try and buy assets again, thinking they're good value because they're at bargain prices, and you get these amazing shootbacks.
Sure.
And that's what happened in the 70s. It was a very, very volatile period.
And it looks like it sat quite well as well for the next few years after that before we hit the next red spell. Gary, I'd like to move on to chart B, which, scatter, I think more scatterbrain of myself when I look at this. It feels like my brain cells socially distancing at the moment. I see this R2, which looks like a formula that mathematicians in us might find familiar, but I'm not a mathematician. So could you please explain chart B?
Okay, so the fact that it doesn't look like it's got any pattern to you is exactly what a non-correlated series looks like. There is no pattern. If there was a strong relationship between GDP and equity returns, those dots would move from bottom left to top right. If there was a perfect relationship, then they would move on a straight line from bottom left to top right, going up at a 45 degrees angle, and R squared would be 1. Now, there's hardly any variables that are that well correlated, but the point of chart B shows it proves that there has been no correlation between equity returns and GDP growth in the past 120 years.
Thanks, Gary. It all sounds technical to a degree, and I don't think we can avoid that to a point, but I think this is well explained. Please take us on to chart C.
So bearing in mind I said earlier that equities tend to anticipate what's going to happen in the economy. If equities and GDP in the same year are not correlated, and equities anticipate what's going to happen, it's fair to say that equities anticipate what earnings are going to be doing in companies in the next few years. And so we should see a relationship if we put a lag in. So chart C looks at the relationship of equities to GDP 1 year away. And what it does show, it's not a strong relationship, but equities tend to be a better indicator of what's going to happen to GDP in the next period than GDP is of what's going to happen to equities currently.
Sure. Thanks, Gary. The final chart, which I'd like you to take us through, I think the message in this one's quite simple, but can you just hit it home for us, please?
So it's quite dramatic, that. Bearing in mind that very few of us will be investing for 120 years. But if you had put £100 away in 1899, then by 2020, the purchasing power had gone up by about 18,000% plus if you invested in equities, and by just over 200% if you invested in gilts. In other words, when you get real improvements in the economy, real improvements of standard of living, you get a massive improvement in equity values, which is to be expected. Whereas with government securities, a lot of the time in the last 120 years, inflation eroded the real value. And it's really only in the last 20, 30 years that those gilts have got back into a realistic positive territory. And that's something to bear in mind, particularly when you're looking at long-term gilt yields, 30 years, giving you a return of less than 0.6 per annum at the moment, which is going to see your capital value and purchasing power eroded dramatically when you're bearing in mind that inflation is targeted at 2%. So I think that final chart is quite powerful. And it says equity investors get very well rewarded. But as I make the point continually, the price you pay for that reward is short-term volatility, and it will always be the price you pay as an equity investor.
Thanks, Gary. I'm just wondering, could you tell us that same story, but from a view of our investment strategy?
Sure, yeah. So what we try and do is minimize the peaks and troughs as much as we can when we're running money for people. We try and make sure that the risk profiling of the portfolio matches up to the risk profile of the investor. And so, for example, if you're in our cautious strategy multi-asset fund, it will wobble a lot less than your growth strategy multi-asset fund. So we are always mindful of how much risk an investor wants to take. But in all our strategies, all the multi-asset funds, we're going to try and get a real return and boost an investor's purchasing power, because that is the real point of investment. The money you put away now, if you take nothing from it, buys you more in 10 years than it does today. And that doesn't always happen with gilts.
Gary, thank you. We've got lots more data to cover, so I think we've got a lot more conversations to have. I'm going to call it stops there. 9 minutes. Time is precious. And I will speak to you soon.
Thanks, Leo.
Thanks, Gary.
Bye.
Take care.